There are two financial systems running in America right now. One requires you to work, earn, get taxed, spend what's left, and call that a life. The other one, the one almost nobody teaches you about, lets you accumulate wealth, access it tax-free, pass it on to your heirs, and never pay the bill. Not defer it, never pay it. And the wildest part? It's completely legal. It's sitting right inside the tax code. And the people who know about it aren't hiding it out of malice. They're just not going to bring it up at your next dinner party. Stay with me, because by the end of this video, you're going to understand why billionaires report almost no taxable income, how they still access hundreds of millions of dollars in cash every year, and this is the part most creators won't touch, how ordinary people with a single investment property can plug into the same system. There are three things I'm going to show you today that most financial influencers either don't understand or are too nervous to explain clearly. And I'm going to give you the number that will change how you think about your paycheck forever. Let's go. If you're someone who works hard, pays a significant chunk of your income in taxes every year, and gets a creeping feeling that the rules of this game were written by people who weren't thinking about you, you're in the right place. This isn't about loopholes in the sketchy sense. This isn't offshore accounts or legal gray zones. This is about understanding how the tax code actually works at the structural level and using it the way it was designed to be used. The confusion isn't your fault. The system is genuinely built in two layers, and most people only ever see one of them. Here's the thing. The IRS reported that the top 1% of earners pay an effective federal tax rate of around 26%. Sounds fair, right? Almost progressive. But when the Federal Reserve and investigative economists have examined the actual wealth accumulation of the ultra-rich, what they spend, what they borrow, what they own, the effective economic tax rate on that wealth is often in the low single digits, sometimes zero. That gap is not an accident. It is the system working exactly as designed. And today, we're going to walk through the exact mechanism that creates it. It starts with a divide that most people feel but can't articulate. Workers earn income. The moment that money lands in your account, the IRS considers it a taxable event. You worked, you got paid, you owe. It doesn't matter what you do with the money after, save it, spend it, invest it. The tax happened the moment you earned it. This is the system that most Americans live inside. And there's nothing wrong with it except for one thing. It's the most expensive way to build wealth that exists. Owners are different. Owners hold assets, and assets, real estate, businesses, stocks, don't trigger a tax event by simply existing, growing, or appreciating. You own a property worth $400,000. Over 5 years, it appreciates to $500,000. That $100,000 in new wealth? The IRS hasn't touched it. You haven't paid a cent. It just sits there, growing, compounding, entirely outside the tax system. For now. The word "for now" is where most people get nervous, and understandably, because here's how most people think it ends. Eventually, you sell. You take that $500,000 check, you subtract your $400,000 basis, and you pay capital gains tax on the $100,000 profit. At the federal level, that's 15 to 20% plus state taxes in most places. That's $15,000 to $20,000 handed over in a single transaction. And if you needed that cash, you had no choice. You sold, you paid, you moved on. That's the only exit strategy most people know. But what if selling isn't actually your only option? This is where the shift happens, and once you see it, you can't unsee it. Instead of selling that $500,000 property, triggering a taxable event, you go to a bank and you borrow against it, a cash-out refinance. Let's say the property has $200,000 in equity. The bank gives you $150,000 as a loan secured by that equity. You now have $150,000 in cash in your account. And here's the critical question. Does the IRS consider that income? No, it doesn't. Borrowed money is not income, it's debt. The IRS does not tax debt. Think about it this way. If you take out a car loan, nobody sends you a 1099 for the money the bank gave you. The same principle applies here, just at a different scale. You've accessed your wealth, real, spendable cash, without selling, without a taxable event, without writing the IRS a check. The referee doesn't blow the whistle if you never score. In this framework, scoring means selling, And as long as you never sell, the game clock keeps running. The property keeps appreciating. The loan sits there, and the interest on that loan, if the property is used for investment, is often tax deductible. You're paying for the loan with pre-tax dollars, while your underlying asset continues to grow. You're borrowing your own wealth back from yourself at a fraction of its total cost. Now, you might be thinking, okay, but you still have to pay that loan back eventually. And that's true. But here's what most people don't realize. The cash flow from the property, rent, income, can service the debt. You're using the asset's own earnings to pay the loan while you deploy the borrowed capital elsewhere. The asset works on two fronts simultaneously. Now, let's build the machine. This is where it goes from interesting to genuinely powerful, because borrowing instead of selling isn't just a one-time trick, it's a repeatable loop. And when you run the loop enough times, something extraordinary happens. Here's the cycle. You buy an asset, it appreciates, you borrow against the equity, not taxed. You take that capital and buy another asset, that asset appreciates, you borrow against its equity, not taxed. You repeat. Each time you go around the loop, your asset base grows, your borrowing capacity grows, and your tax bill stays at zero, because you have never sold a single thing. This is what financial strategists sometimes call the zero-tax snowball, and once it gets moving, it becomes extraordinarily difficult to stop. Now here's the part that sounds almost too good to be true, but it isn't, and the IRS knows it, and it's sitting right in the tax code in plain sight. What happens when you die? When you pass assets to your heirs, something called a step-up in basis occurs. That means the cost basis of the asset, the number that determines how much of a gain you'd owe taxes on, resets to the fair market value at the time of your death. Let me make that concrete. You bought a property for $400,000. Over decades, it grew to $2 million. If you had sold it, you'd owe capital gains on a $1.6 million gain. But if you hold it until death and pass it to your children, their basis is now $2 million. The entire $1.6 million gain is permanently erased from the tax system. Not deferred, gone, forever. This is what borrow until you die actually means. You access your wealth through loans during your lifetime, tax-free. You hold the assets through death. The gain resets, the loan gets paid off by the estate, and your heirs receive the asset, the appreciation, and a clean slate. Elon Musk borrowed billions against his Tesla stock rather than selling shares. Mark Zuckerberg has done the same with Meta. This isn't news. It's been reported by ProPublica, by the Wall Street Journal, by basically every financial publication that's been paying attention. The strategy isn't secret. It's just poorly explained to the people who could actually benefit from understanding it. Now, here's the twist, and this is the part I promised you earlier that most creators don't touch. Everything I've described so far works best when you already have substantial assets. But what about the person earning $100,000 in W-2 income, paying $20,000 or more in federal taxes every year, and wants to get into this system? Is there an entry point? Yes, and it lives inside a specific section of the tax code that most accountants don't bring up unless you ask. It involves real estate, paper losses, and something called cost segregation. Here's how it works. The IRS allows real estate investors to depreciate their properties over time, essentially to claim that the building is slowly losing value, even as it appreciates in the market. This creates what's called a paper loss, a loss that exists on your return but not in your bank account. Normally, those paper losses can only offset passive income, rent from other properties, not your salary. But there's an exception, and that exception is called the short-term rental loophole. If you own a property that you rent out short-term, think Airbnb, VRBO, 7-day average stays, and actively participate in managing it, that rental activity is not classified as passive income, it's non-passive. And non-passive losses from real estate can be offset against ordinary W-2 income. That means your $100,000 salary. Now layer in something called bonus depreciation. The IRS allows certain components of a property, appliances, flooring, fixtures, landscaping, to depreciate much faster than the 27.5-year standard for residential real estate. Through a cost segregation study, an engineer reclassifies those components, and you can potentially front-load years of depreciation into a single tax year. We're talking about taking a $500,000 property and generating $125,000 or more in paper losses in year one. Run the math. You earned $100,000 in W-2 income. Your tax bill should be around $20,000, but your accountant runs a cost segregation study on your short-term rental. You generate $125,000 in accelerated depreciation losses. Those losses offset your $100,000 completely. Your federal tax liability goes from $20,000 to zero. That $20,000 stays in your pocket. It becomes deployable capital, which you use to buy the next asset. This is the entry point. This is how W-2 earners get into the zero tax snowball. Let me connect everything now, because this is where it all becomes a single coherent system. You buy a short-term rental property, you generate cash flow from guests, you use cost segregation and bonus depreciation to wipe out your income tax bill.
That freed capital, the taxes you didn't pay, you redeploy into the down payment on the next property. The first property appreciates. You do a cash-out refinance, pulling equity tax-free. That capital funds the third property. The third property generates more paper losses, offsetting more income. You're now paying almost nothing in taxes, acquiring assets, building equity, and compounding capital simultaneously. The cash flow feeds the equity feeds the borrowing feeds the acquisition feeds the deductions reduce the tax bill, the reduced tax bill feeds more deployable capital, and the loop runs itself. This isn't theoretical. This is the financial operating system that a relatively small percentage of Americans are running, not because they're smarter, not because they inherited wealth, but because they understood the architecture of the system and built a strategy around it. According to Federal Reserve data, the wealthiest 10% of Americans own roughly 93% of all stocks and mutual funds, and an overwhelming share of real estate investment assets. That's not because the game is rigged in some conspiratorial sense. It's because the rules, the actual written rules sitting in the tax code, reward ownership, equity building, and long-term holding in ways that wage income simply cannot compete with. The question is not whether this system exists. The question is whether you're going to engage with it. You now understand the two tax systems. You understand why borrowed money doesn't trigger a taxable event. You understand the zero tax snowball, the step up in basis, how billionaires live on loans, and critically, how someone with a single rental property can use cost segregation in the short-term rental exception to start reducing their tax bill right now, this year. But here's what I haven't shown you yet. What happens when you own just one rental property, not a portfolio, not millions in equity, and you start running this system from the very beginning? What does year one actually look like? What do you tell your accountant? What kind of property qualifies? How do you find a cost segregation engineer, and what does it actually cost? That's part 3, and it's going to be the most practical video in this series. Subscribe and turn on notifications because that one goes live next week, and if this video connected for you, that one is going to change how you file your taxes. See you there.